Charlie Munger, who is a great investor and partner of Warren Buffett, often talks about the concept of inversion and how to use it when trying to come up with answers to tough questions.
One of my favorite tricks is the inversion process. If somebody hired me to fix India, I would immediately say, what could I do if I really wanted to hurt India? And I'd figure out all the things that could most easily hurt India, and then I'd figure out how to avoid them. Now, you'd say it's the same thing, it's just in reverse. But it works better to frequently to invert the problem.
So in today's video, rather than asking what are 3 dividend stocks that are undervalued and I should buy now, I'll be asking the question, what are 3 dividend stocks that are overvalued and I should avoid right now? And hopefully the answer to this question will help us to make better investing decisions. Tech stocks have done tremendously well this year in terms of their stock price, and a lot of them could probably be classified as overvalued. So I could probably just point to 3 tech stocks and talk exclusively about tech, but I do want to include some other companies as well in other industries. So I will have a tech company on the list, but that's only going to be one company, and that will be the last of the 3 companies that I discuss. The first company on the list actually that I think is overpriced right now is McDonald's, ticker symbol MCD. McDonald's is certainly a very high quality company and business, but right now it's just trading at a very high valuation in my opinion, and I don't really think that the company is really worth that price. Like I said, fundamentally McDonald's is a strong business. Even though their revenue, as we can see, hasn't necessarily been a steady upward climb, they have been focusing in recent years on improving margins and net income, and they haven't really been focused as much on revenue. And we can see that the net income trend is showing that that focus is paying off, and their net income and margins are generally going up over the last few years and over time. McDonald's has also done a great job of returning value to shareholders. The first way they've done that is through share repurchases, and we can see the trend of shares outstanding right here, and it's just steadily going down, which is great for shareholders. And then also McDonald's does pay a dividend. Right now it's about a 2% yield, and the payout ratio is pretty healthy at 55%. And over the last 5 years, the average dividend growth rate has been about 8%, with 46 consecutive years of dividend increases. So all that data really points to McDonald's being a solid company, but right now, like I've said, the valuation is just much too high for my liking. The price to earnings ratio right now is around 31, and the share price is in the $290 to $300 range, which is a lot higher than the fair value that I calculated of around $150 per share. I do think the company is worth a little bit more than $150 per share, and I'd probably be pretty excited to buy the stock in the $200 to $225 range. But right now, like we can see, the stock price is just way above that, and I think the company as a whole is just overvalued in the stock market. The next dividend stock that I think is quite overvalued right now is Caterpillar, ticker symbol CAT. Again, Caterpillar is a pretty strong business fundamentally. They're a bit more cyclical than McDonald's, as we can see by this graph of revenue over the past 13 years, but they do have a strong share buyback program, as we can see from this trend line in this chart, and that has really helped their earnings per share go steadily higher, even though their business has been cyclical in nature. Additionally, Caterpillar does have a little bit more debt than I would like to see, but compared to their shareholders' equity, it's really not that bad. They have about $25 billion of debt in that range, and their shareholders' equity is around $18 billion. From a valuation perspective, though, that debt does hurt them a decent amount. My calculation of fair value was around $150 per share, and currently the stock is trading around $260 per share, which is a lot higher. Right now the PE ratio is around 20, which doesn't really seem all that high, but I personally think that Caterpillar's business is sort of reaching the peak of the cycle per se, and so I think it's going to likely falter a little bit and probably slow down sometime in the next few years. So the earnings will likely go down, and then the price will have to go down to maintain that PE ratio, or the PE ratio will just go up a lot. So ultimately, I'm really not all that interested in the stock if it's above $200 per share. I think, if I really felt like I wanted to invest my cash somewhere, I might consider it around, $220 per share, but really not any higher than that, I don't think. And honestly, I'd really only get super excited about the stock if it was, around $175 or below. So like I've said, I do think it's pretty overvalued right now. The third and final dividend stock on our list today is that tech stock that I promised, and it's none other than Apple, ticker symbol AAPL. Now, don't come out here and get mad at me. Don't accuse me of being an Apple bear. I'm not predicting that the stock's going to go down. I certainly don't know what's going to happen with the stock price. I'm not predicting that the company is going to go bankrupt in the next year or the next 5 years. I'm not even predicting that I think the company is going to do poorly over the next few years. All I'm saying is that I don't think the company is worth $3 trillion right now. Clearly, Apple is one of the finest businesses in the world, with a fantastic record of growing their revenue and earnings per share at a very respectable rate. They've really been plowing cash into share buybacks over the last 10 years, as we can see, and they've made a huge dent in their shares outstanding. And shockingly, even with all those share buybacks, they still have over $50 billion of cash on hand. And they do pay a dividend. It's quite small right now, but they have been growing it at a fairly reasonable rate, and I personally expect that to continue for quite some time. I am an Android and Windows user, so sometimes I do say things to kind of hate on Apple products a little bit. But at the end of the day, they really do have an excellent suite of products that work well together. And that really creates extraordinarily strong brand and customer loyalty, which is really ultimately a great business strategy. But back to the valuation, their price to earnings ratio right now is 33, which is just way out of line with their historical levels, as we can see here. And it really points to nothing but overvaluation. Really, the vast majority of the tech sector looks overvalued to me right now. And Apple almost seems to be kind of pushing that overvaluation, especially with their recent milestone they hit of surpassing a $3 trillion market cap and actually closing the day above $3 trillion. And, so far they've been trading for a few days, maybe even weeks above a $3 trillion market cap. From my discounted cash flow model, I calculated a fair value of between $120 and $130, which the stock was at just at the beginning of this calendar year. And now it's all the way up above $190 per share. I have personally been buying stock, below $150 a share a lot. Pretty much the entire third quarter of 2022, I was consistently buying Apple stock. It started the third quarter around $150 per share and kind of went slowly down until the end of the year, ending the year, around $125 per share. So I was really buying throughout that whole time period. And for me, I think $150 is where I'd kind of want to see the stock before I got pretty interested in it again and started buying a lot more. A little side note on Apple, I personally think this Vision Pro headset, VR headset that they announced a few months ago, is pretty ridiculously priced, and I'm pretty skeptical as to how it's going to do. But I have to remind myself that, Apple has just continued to deliver time and time again on their products. And so that does give me a little confidence. And in the back of my mind, that kind of makes me think that the headset is going to do a great job and it's going to sell a lot. I kind of think it might take a few tweaks and changes over the next few years to make that happen. But I think ultimately that Apple is probably going to make it work. So those are 3 dividend stocks that I think are overvalued right now. And I'm personally avoiding all of these, haven't really been buying any of them in recent months. Hopefully this inversion technique has helped you think of stocks that you think are overvalued right now. And ultimately, I think that'll give you a better idea of other stocks that actually might be attractive right now. So let me know in the comments below if you agree with my choices and what stocks you think are overvalued as well. If you want to chat about it, feel free to join the free Discord server where you can talk with myself and other long-term investors. If you haven't already, make sure to subscribe to the channel so you don't miss out on future videos. Thanks for watching, and I'll see you all in the next one.